stop. Before you buy that stock because of a strong buy rating, you need to watch this. I'm about to show you how you could save thousands because did you know that Wall Street analysts are barely more accurate than flipping a coin? I'm talking 47% accurate. That's worse than random chance. Today we're decoding these analysts' ratings and exposing the shocking truth about Wall Street's biggest recommendations. Welcome back to StockScope Live. I'm your host, Ali, and if you're tired of losing money on analyst recommendations, you're in the right place. In the next 12 minutes, I'm going to show you exactly why some analyst ratings are pure gold and the other ones are trash. And we'll cover 7 red flags you need to watch for. I'm going to reveal which firms actually deliver results and show you how to use the ratings without getting burned. First, hit the subscribe button and ring the bell because what you're about to learn isn't taught in business school and Wall Street definitely does not want you to know it. So let's dive in. All right. If you don't have a lot of time, this is what you need to take away. There was a recent research analyzing 5,800 analyst predictions, and the overall accuracy rate was just 47%. Think about that. You'll do better if you flip the coin. Now, let's dive in. Here's what really shocked me. Jim Cramer, the guy that screams buy, buy, buy on CNBC, has an accuracy rating of 46.8%. Abby Joseph from Goldman Sachs, even worse, 35%. And they're supposed to be the experts. But here's where it gets really interesting. Not all analysts are created equal. So let's reveal who has actually good ratings. The Deutsche Bank leads the pack with 65.6 accuracy on 610 predictions. JPMorgan follows closely behind at 65.3%. The Bank of America got to 64.8%, while Goldman Sachs, with all its prestige, is actually only at 59.8%. It goes further than that. Analysts are significantly better at sell recommendations, hitting 70.1 accuracy. JP Morgan crushes it with an 80.5 accuracy on sell ratings. This tells us something crucial about market psychology and conflict of interests that we'll explore more in the next segment. Okay, let's talk about the elephant in the room, conflict of interest. This is where things get really dirty, and it explains why buy ratings are so inflated. Think about it. Investment banks make money from underwriting IPOs and mergers and other deals. If an analyst gives a company a negative rating, that company might take their business elsewhere. It's that simple. The 2003 settlement where 10 Wall Street firms paid $1.4 billion in penalties proves this isn't conspiracy theory. It's documented facts. And here's what happened behind the scenes. Analysts face pressure to maintain relationships between corporate clients and not having negative reports that could kill a potential deal. Some of these deals are worth millions in fees. So what do? They stay optimistic, even when they shouldn't. The research is actually very clear. Recommendations levels are positively correlated with conflict magnitude, meaning that the more conflict there is, the higher the recommendations for positive buys. During the late 1990s bubble, this optimistic bias was especially pronounced. But here's the kicker. The market actually recognizes these conflicts and discounts the opinions accordingly. Decision fatigue is another huge factor. Analysts that are covering multiple companies throughout the day, they're showing decline in accuracy as the day progresses. By the afternoon, they're taking shortcuts, reissuing previous forecasts, or just going with consensus. First impression bias and recency bias further cloud their judgments. Okay, now let's get to the practical part. Here is the 7 red flags that should make you extremely cautious about analysts' ratings. Number 1, the strong buy inflation. When you see mostly strong buys and buy ratings with very, very few sells, that should be a red flag because legitimate analysis should show more distribution. Red flag number 2, investment banking relationships. Always check if the firm has recent underwriting or advisory relationships with the company they're rating for. This should be disclosed, but it's often buried in fine print. Red flag number 3, price target inflation. When price targets seem disconnected from realistic fundamentals, or they're based on aggressive growth assumptions, you should be very skeptical. Red flag number 4, timing of the upgrades, meaning the change between sell to buy or strong buy or vice versa. Be wary of upgrades that come right after major stock moves higher. This often represents analysts chasing momentum rather than identifying value. Stock red flag number 5, lack of downside discussion. Quality analysis discusses risks and potential downward scenarios. Reports that only focus on the upsides, they're sus, and you should be careful. Red flag number 6, the ones that use generic language. Make sure you watch out for copy-paste language across multiple reports, or even vague recommendations without specific reasonings. And the last, red flag number 7, the analyst track record. Make sure that you research the analyst, the individual. Figure out what their historical accuracy is. Some platforms do track this data, and you should be using it. Hey guys, now I'm not telling you to ignore the analyst's ratings completely, but you should use it properly. They're one tool in your toolkit. And here is how I think you should do it. First, look for consensus changes, not individual ratings. When multiple analysts from different firms move in the same direction, that's more meaningful than one upgrade or one downgrade. Secondly, focus on the research, not the rating. You need to read the actual report. Look at their assumptions, look at their model, look at their risk assessment. The rating is just a summary. The real value is in the analysis. Third, pay attention to sell-side versus buy-side differences. Remember that sell-side analysts work for brokerages and have those conflicts we discussed prior. But buy-side analysts, they work for fund companies and face different types of pressures. Number 4, consider the timing. Analysts aren't always reporting in real time. There's market conditions that change quickly. Use the rating as historical context, not current market direction. 5th, diversify your sources. Don't rely on Wall Street alone. Look at independent research firms, quantitative models, and do your own fundamental analysis. We're seeing interesting moves right now. For example, the Deutsche Bank just reiterated a buy rating on Tesla with a price target at $435. Real estate sectors are slowing and showing discounts of about 7%. Small cap stocks remain 15% undervalued, according to the Morningstar analysts. But remember, you should use this as a starting point. Make it the starting point to your own research. Don't take their word for it. All right, guys, here's what I want you to do right now. First, if this video saved you from making costly mistakes, or if you learned something valuable, smash the like button. It really helps the channel grow, and I appreciate your support. Second, please subscribe and hit the bell so you never miss out on market analysis like this. Remember, successful investing isn't about following the crowd or trusting the so-called experts blindly. It's about developing your own analytical skills and using all available information wisely. Analyst ratings is just part of that process. They should never be the whole process. The market rewards independent thinking, not herd mentality. Next week, we might be diving into small cap value opportunities that analysts are finally starting to notice, and you won't want to miss it. Until then, keep your analysis sharp, your risk management tighter, and remember, in investing, skepticism isn't cynicism, it's survival. I'll see you in the next video.